Have you ever wondered what a credit score actually is? Why people talk about credit scores and why credit scores matter? And how does it really affect your daily life? Maybe you've heard someone say, I couldn't get a mortgage because of my credit score. Oh, I've got an excellent credit score and therefore I got a better deal. What exactly is a credit score and how do banks and lenders in the UK use it? Credit score is a number that gives an indication of how reliable you have been when borrowing or repaying money. Think of it as a summary of your financial borrowing history. In the UK, credit scores are produced by credit reference agencies such as Experian, Equifax, and TransUnion. Each of these agencies will use its own scoring system, so you may have a slightly different score with each different agency. Now, the exact number isn't really the most important thing. What's more important is the information behind the score, known as the credit report. Now, credit report contains more details, such as one, the credit cards you've had, the loans you've taken out, whether you've paid on time, any missed payments, and any county court judgments or CCJs. They also include bankruptcies and insolvency. The other thing they also include are your electoral register information, how long you've stayed at your current address, and how much of your available credit you're using. The score simply turns all of that information into an easy to understand number. You can think of it like a school report grade, and the grade gives a quick indication of performance, but the actual report contains the details which financial institutions are more interested in. So here's something many people don't realize. UK banks and lenders usually do not rely solely on the credit score you see on the consumer apps. Instead, they look at the information contained within your credit report and combine it with their own assessment criteria. When you apply for things like a mortgage, a credit card, a personal loan, car finance, or even a mobile phone contract, the lender wants to answer one question. How likely is this person to repay us? To make that decision, they may consider the following: your credit history, your income, your existing debts, your employment status, your affordability, and your previous repayment behaviors. Your credit report helps them assess the risk. If your history suggests you've consistently paid bills on time, you generally appear less risky. If you've frequently missed payments or defaulted on debts, you may appear more risky. The higher the perceived risk, the more cautious the lender may be. So let's look at an example. So imagine Sarah. Over the past few years, she has been living life. So things have happened. She's missed several credit card payments. She's exceeded her credit limit. She's defaulted on a loan, and she has a CCJ recorded on her credit file. As a result, her credit profile appears risky to lenders. So what could happen? When she applies for a loan, she may be declined. She may be offered a smaller amount, or she may face higher interest rates. For example, if someone with a strong credit profile is offered a loan at 6% interest, Sarah might only qualify at 15% or even higher. And that means borrowing becomes more expensive. A poor credit profile can also affect everyday life, and Sarah may find it harder to obtain a mortgage, to get approved for a credit card, to finance a vehicle, to secure mobile phone contracts, or even access the most competitive financial products. It's important to note that having a poor credit history doesn't mean someone can never borrow again. Many lenders do offer products designed to help people rebuild their credit over time. Okay, so let's consider another example. Let's say this is Jane. So for years, Jane has paid all her bills on time. She keeps credit card balances low. She has never missed any repayments and manages her credit card responsibly. As a result, her credit profile seems lower risk. When Jane applies for borrowing, lenders may be more willing to approve her application. She may benefit from low interest rates and higher credit limits, more borrowing options, and an access to premium financial products. For example, when applying for a mortgage, even a slightly lower interest rate can save thousands of pounds over the lifetime of the loan. An excellent credit profile doesn't guarantee approval, though. Lenders still look at the income, the affordability, and other factors. However, it can improve the chances of receiving competitive offers. Many people assume credit scores only matter when applied for loans. In reality, credit history can influence several aspects of everyday life. For example, one, renting a property. Some landlords and letting agents perform credit checks as part of the tenant screening process. They may want reassurance that rent payments are likely to be made on time. Mobile phone contracts. When applying for monthly phone contracts, providers often perform credit checks because they are effectively providing services before receiving full payment. Utility accounts. Some energy suppliers may use credit information when assessing payment arrangements. And then, of course, the big one, mortgages. For most people, buying a home is the biggest financial commitment they'll ever make. And a strong credit profile can improve mortgage options, potentially reducing borrowing costs. So, in short, your credit history can influence how easily you access various financial products and services. If your credit profile isn't where you'd like it to be, there are several practical steps that can help over time. These include paying your bills on time, keeping your credit utilization low, and registering to vote at your current address. You should avoid unnecessary credit applications and check your credit reports for errors. Maintain your accounts responsibly and try not to draw cash from credit cards. Now, improvement usually takes time and there are rarely quick fixes, so your credit history is built through consistent financial behavior over months and years. So, in conclusion, what is a credit score? It's a numerical summary of information in your credit report that helps indicate how you've managed borrowing in the past. Financial institutions use that information along with income, affordability, and other factors to assess the lending risk. And a strong credit profile can open up more options and potentially lower your borrowing costs, while a poor credit profile can make access to credit more difficult and even more expensive. If you found this video helpful, don't forget to like and subscribe and share it with anyone who wants a clearer understanding of credit scores in the UK. Now, if you've made it this far, here is a bonus. I am going to share my own credit report, and you can see it is 1,000 out of 1,000, a clean bill of health. Thank you so much. Till next time. Bye bye.